Hi guys, this is Aditya Vora here. A few years ago, when I began my career in equity research, my first job was at a leading domestic brokerage house. One of the many things I learned from market veterans there was the concept of sector rotation or investing in sectors which are in flavor. My head of research shared an important concept about investing in large cap stocks. The difference between the fund managers of large cap mutual funds outperforming or underperforming each other is not as much dependent on stock selection but more about assigning weights to sectors. In simple terms, it's all about how much overweight or underweight you are on a particular sector. This is because the stocks in which the large cap fund managers invest are mostly the same. After all, you can't experiment a lot when it comes to large cap space. The best you can do is to take a call on which sector will be in flavor over the next couple of years. Think of it in this way. Fund managers and CIOs of reputed mutual funds are not known for individual stock calls but their sector calls. Take the example of HDFC Mutual Fund star fund manager Prashant Jain. He made a bold call betting on PSU stocks and the public sector banks in the early part of the last decade. Unfortunate for him, he was ahead of the curve. It's no wonder that a majority of large cap HDFC schemes underperformed the benchmark indices. Now, take the example of S. Naren, the CIO of ICICI Prudential Mutual Fund. His large cap funds were overweight on the power sector in 2019. His logic stemmed from the fact that the power and utility firms had seen no earnings growth over the past 10 years. If market leaders were available close to book value, then they sure would have the ingredients to create all the wealth. And sure enough, stocks like NTPC and Power Grid doubled. The point I'm trying to make is that as an investor in large cap stocks, it's pertinent to focus more on the sector rather than specific stocks. Instead of picking stocks, focus on an industry which has multiple tailwinds. Then look to invest 4 to 5 good stocks in that sector. Now the question is, why 4 to 5 stocks? So last year the PSU Banking Index doubled. Imagine if you got that sector call right but only bought SBI. While SBI gave a 31% return, stocks like Bank of Baroda and Canara Bank doubled. So buying a basket of stocks in the industry you think is going to be an outperformer makes a lot of sense. Now, this strategy is obviously fraught with risk. What if the sector doesn't perform and you own multiple stocks from that same sector? You will definitely underperform and underperform badly. While banking was the star in 2022 and continues to do well, the valuations of the stocks, especially the private sector banks, have started to look high. The table in the slide clearly shows the sharp run-up in the banking stock valuations. I mean, we are not at a stage where the banking stocks are extremely expensive, but gone are those days where the margin of safety was huge. All of them are trading at a premium to their 5-year price to book ratio. While banking stocks are a tad bit expensive, my attention fell on the NBFCs, which are nothing but a subset of the banking space. If you go to see, almost the same tailwinds apply to the NBFC space as they do to the banking sector. In that case, why not look at the NBFC stocks? If you look at the valuations, many of the smaller NBFCs are still available at a discount to its 5-year median valuations. Some are in fact available below or close to their book value. Now, if you look at the table in the slide, leaving aside Bajaj Finance, which trades at an 8 times price to book, and Mahindra Finance, which is at a premium to its 5-year average valuations, the other two stocks are actually cheap. Look at LIC Housing Finance and L&T Finance. That is a combination of sector tailwinds plus cheap valuations which merit a look in the stock. Now, before I talk about LIC Housing Finance, let me talk about the banking industry tailwinds and why I believe they are more favorable for the NBFCs rather than the banks going forward. To give you a background, since the ILFS crisis of 2018, the banking sector's fundamentals have become resilient. Slowly but surely, things have definitely fallen in place. If you look at inflation, inflation has likely peaked. The interest rate cycle too has peaked along with it. There is high liquidity in the bond market. This enables NBFC to borrow funds comfortably. And last but not the least, asset quality levels are looking the best for a long time. Another pertinent point is that while the repo rate increased by 2.5% since FY22, the 3-year corporate AAA rated bond yields have gone up by just 1.6%. Also, the MCLR, which is the marginal cost based lending rate, which is the rate at which the NBFCs borrow from the banks, has gone up by just 1.35%. This partial transmission of higher interest rates has helped NBFCs manage their cost and the net interest margins. Now, when interest rates decline going forward, NBFCs will shift their borrowings from banks at the MCLR to the bond market. This is because the 3-year AAA rated corporate bonds are at a discount to the bank lending rates. With abundant liquidity, I don't see why the cost of borrowing for NBFCs should go up. So friends, the question is, when will the perception move in favor of NBFCs? I believe the NBFC dominance over banks in terms of fundamentals will start when the interest rates start to go down during the latter part of the year. The decline in the repo rate will be a game changer for NBFCs. Banks have roughly 30 to 40% of loans which are linked to the repo rate. NBFCs have a large proportion of fixed rate loans. So what happens is that this will aid margins when the borrowing cost for the banking industry starts to come down gradually during the latter part of the year. While banks had a stellar run in 2022, some NBFCs, despite the industry tailwinds, are available at dirt cheap valuations. Despite a decent run-up, many NBFC stocks are available at valuations which are below pre-COVID levels. And now, coming to the stock in contention, LIC Housing Finance. It is said in banking that the growth problem can be resolved, but the asset quality problem is a bigger mess. However, LIC Housing Finance, the problem is growth and not asset quality. Loan growth has been barely 4% compounded over the past 5 years, while net profits have also grown at a disappointing 4% over the past 5 years. The return on equity for LIC Housing Finance, which was 15 to 16% 5 years ago, has come down to 12% in FY23. However, if you look at from a margin perspective, things are gradually improving. The company closed FY23 with a net interest margin of 2.9%. The full financial year, the net interest margin was 2.4% as against 2.2% a year ago. When we talk about NPAs, I don't see that as a problem, with net NPAs hovering around 2.7%. The problem is just bad financials which led to valuation multiple derating over the past 5 to 7 years. No wonder the stock is available at a 0.7 times price to book value, which is a 30% discount to its median valuations. And of course, the stock has a 2.5% current dividend yield at the current price. In my view, the day growth starts coming in and the company does something to arrest the falling market share, the stock will definitely re-rate. The risk-reward ratio is very favorable for a strong company like LIC Housing Finance, which is available at dirt cheap valuations. And also, in my experience, when industry tailwinds are strong, market leaders are the first one to benefit, followed by laggards. So friends, do let me know your views and thoughts about the video in the comment section, and don't forget to like the video too. Thank you.